Over a 20-year period, the S&P 500 returned about 8% annually, outpacing most asset classes. But the average individual investor only earned about 2% in the same period. Why the massive gap? Because investors try to beat the market by picking individual stocks, and data shows that most of them fail horribly. On the flip side, an index fund is simple. It buys everything: Apple, Amazon, Google, all at once. No guessing, no gambling. So why are people still trying to outsmart the market? Because of articles like this. $1,000 invested in Apple stocks 20 years ago would be worth about $214,000 today. Or that $1,000 invested in Nvidia stock would be worth about $1.2 million. There are plenty of articles like this, and it's true. Individual stocks can sometimes massively outperform the overall market. The temptation of stock picking is that maybe you can discover the next Apple or the next Nvidia early and then ride it to fortune. But here's what you don't often hear. For every Apple, there's a Kodak or an Enron, once great companies that crash and burn. For every Tesla, there are dozens of startups that never made it. The success stories often make the headlines. The failures? They quietly vanish. This is called survivorship bias. We remember the winners and forget about the many losers. The result? Stock picking can feel easier than it actually is because we overestimate our ability to pick winners. Do you remember BlackBerry or Nokia? Once upon a time, these were tech giants and industry leaders. Investors poured billions into them. But then technology shifted, consumer preferences changed, and their stock price plummeted. Even if you had carefully researched and confidently chosen the safe bets, you could have still watched your investments lose most of its value. Then there was Circuit City, Blockbuster. I could go on and on. The point here is that predicting long-term winner is not just about identifying current leaders. It's also about anticipating future disruptors, which history shows is notoriously difficult even for seasoned investors. I can tell that you're still not convinced. So let's look at the data. A comprehensive study done of US stocks from 1926 to 2016 found that just 4% of all stocks accounted for all the net wealth creation in the stock market over the 90-year period. In other words, a tiny minority of superstar companies drove the market's gains, and the other 96% of stocks collectively just broke even, matching the returns of one-month treasury bills, which are basically near zero real returns. So if you randomly picked a stock from that century-long period, the odds were very low that you would pick one of the elite 4% that really propelled wealth. If you missed those rare winners, your portfolio would have lagged badly. Take a look at this chart again. The S&P 500 returned about 8% annually, outpacing most asset classes, but the average individual investor earned only 2% annually in the same period. That's basically just keeping up with inflation, meaning no real wealth was gained. Now let's talk about professional money managers, the stock-picking pros who run mutual funds and hedge funds. According to this research, almost 73% of active US stock fund managers underperformed the market in a single year. A staggering 95% underperformed over a 5-year period, and over a 15-year period, virtually none of the active managers beat the index consistently. These are professionals devoting their careers to this, yet year after year, most of them were outdone by a simple index fund. Another report by Morningstar similarly found that less than 1/4 of all active funds outperformed index funds over the past decade, and in the large cap stock category, only 5 to 7% of funds managed to both survive and beat the index over a 10-year period. Now, to really drive this home, do you remember that famous $1 million bet that Warren Buffett made? In 2008, Buffett bet that over a 10-year period, a basic S&P 500 index fund would outperform a selection of fancy hedge funds. Fast forward to 2017, the index fund won easily. The S&P 500 gained about 125%, whereas the basket of hedge funds gained only about 88%. Despite teams of managers and high fees, these funds could not keep up with one low-cost index fund. This wasn't in some unusually favorable period either. It's a phenomenon that we see repeatedly. So why is it that stock picking is so incredibly difficult? And why index funds so consistently come out on top? It boils down to a few key reasons. First, and perhaps the biggest secret of index fund, is that you automatically own the big winners. Think about the last 10 to 20 years. Amazon, Google, Netflix became huge success stories. If you had the S&P 500 index fund, you owned them once they grew into large caps and benefited from their ascent. You did not have to predict in advance which unknown small company would change the world. Index naturally gravitated to include emerging giants. Second, diversification. An index fund owns hundreds of stocks. When a few companies stumble, it's not a big deal. Others in the index are likely doing well. But if you own 5 stocks and one of them tanks, that's 20% of your overall portfolio. And third, the market is efficient. Well, mostly. In the US, stock market information spreads quickly. The price of a stock tends to already reflect the unknown information and collective wisdom or folly of millions of investors. Unless you have some unique insider edge that others haven't figured out yet, it's hard to consistently find undervalued or overvalued stocks. Average investor often ends up trading on hunches or headlines that are already baked into the price. Essentially, when you buy a stock thinking it will shoot up, someone else is selling it thinking it won't. What makes you think that you're right and they're wrong? Buffett is one of the greatest stock pickers of all time, yet he's the first to tell regular folks to not try and imitate him. He has famously said that a very low-cost index is going to beat the majority of amateur managed money or professionally managed money. Coming from a guy who literally made his fortune picking stocks, that's powerful. Jack Bogle said something similar. Don't look for the needle in the haystack, just buy the haystack. So, what's the lesson here? Investing does not have to be complicated to be effective. An S&P 500 index fund gives you a piece of virtually the entire US economy. As American businesses grow and prosper over the years, so does your investment. There will be ups and downs, of course, market crashes, recessions, boom and bust, bubbles, but historically speaking, the general direction has been upwards. By the way, does this mean that you will never own individual stocks or that there's something wrong with owning individual stocks? Not necessarily. Some people enjoy it as a hobby and allocate a small portion of the portfolio to play with stocks. But for your core wealth-building strategy, the evidence suggests that putting a bulk of your money in a broad index fund is a smart, low-stress way to go. If you're wondering where I put my money, well, you probably already know the answer. BOO, which is the S&P 500 index fund, makes up 50% of my personal portfolio, which means that I automatically invest in 500 of the largest and most successful companies in America. On top of that, I allocate 20% of my portfolio to VUG, which is the Vanguard Growth Fund. I do own a handful of individual stocks as well, but they are a very small piece of my overall portfolio. Before I wrap this up, let me share a quick story. My friend Luke made a huge bet on Wells Fargo stock not too long ago, convinced that he had picked a winner. But then the scandals hit and the stock tanked. Luke waited years just to break even. All those years, his money could have been working alongside the rest of the market. Then him and I were talking about index fund investing, and we were also discussing the book The Simple Path to Wealth, and Luke was able to somehow break even on the Wells Fargo stock and made the switch to index funds completely. So I think I was able to convince him, and I hope that I've convinced you as well. Remember, investing does not have to be complicated. Keep it simple. And the next time you get that hot stock tip or feel the urge to gamble on the latest meme stock, take a deep breath, remember this video, and remember an easy data-backed alternative is sitting right there in the form of an index fund.